Good morning, everyone. Welcome back to the October Ag Economic Dialogue sessions. We're glad to have you here today. We've got two presentations. The topics didn't really line up super well for one fancy title, but we're going to cover some calf prices and economics, and then also look at the what's going on with that farm bill and the situation out there in DC. So with that, I'm going to turn it over to Dr. Dearson, and he can share his slides, and away we'll go. Please feel free, questions, comments, ideas, type them into the chat. Let us know what's going on.
The last few weeks have been taking a little bit of it's that time of year, so I've taken a look at the general economics related to backgrounding. Backgrounding would just be feeding cattle from calf weight or 5 to 6 weight in South Dakota into 2025, and taking a look at some of the numbers and prices related to that. So here goes. Big picture, this is from January 1st of 2024. This is the feeder cattle supplies outside of feedlots. So how many cattle are out there that could enter feedlots, or how many cattle haven't been spoken for, how many aren't already called replacement heifers, for example. So that number was at a fairly low, just over 24 million head for the United States. And we really don't have a good update of that figure since that time. There was no mid-year NASS cattle inventory report because of funding challenges. So there's no way to cleanly update this number. We don't have an estimate of the 2024 calf crop at all. So you could extrapolate or take some guesses from previous years and look at slaughter rates and things like that to try to get a feel for what that number would look like. Those guesstimates would put the number at a little bit tighter than last year heading into 2025. So what that means is we've got a limited supply of calves and cattle that can go into feedlots to be placed on full feed to give us beef supplies, say in 2025 and beyond. So that big picture thing is holding back the number or keeping a lid on the supply of cattle, and it generally means that you've got high or relatively high calf prices. A couple other things just as a way of setting the stage for this. I'm going to talk about the returns for specifically feeding or backgrounding calves. At the same time, cow-calf producers need to look at the big picture and what kind of returns you're getting for using things like your available pasture, hay, and corn to feed your other animals. So in this case, we've got cow-calf returns. The projections for the next couple of years, cow-calf returns from the LMIC give you very high nominal values per head, per cow out there for the next couple of years. So the prospects for the cow-calf side of things look very positive. You do have to adjust for inflation and some of that fun stuff. But for the most part, you're looking at reasonably profitable years if you can produce a calf. So you don't want to use limited resources if that's a constraining factor and do something like use up all your feed or all your pasture backgrounding if that's not as profitable as the longer run prospect of cow-calf returns, say next year or the year after, just for discussion's sake. What are those calf prices doing for a very long time now, which is hard to say. We've been collecting and putting together a weighted average of 500 to 600 pound steer calves sold through South Dakota auction barns reported by the Agricultural Marketing Service. So this is a weighted average of 5 to 6 weights. You can see we've got a number of the early years in the series here, 19 through 21, relatively low, and then last year, 2023, these maroon colored chart or line going through here. Last fall or this time of year last year, prices had been hovering around $3. And then it slipped a little bit as we got into the bigger runs of fall calves. 2024, the price had been very, very high throughout the first half of 2024, and then the price declined a little bit during a very thin time of year where there are very few calves weighing 500 to 600 pounds run through those reporting sale barns. And then very recently, we've seen an uptick in in slightly bigger runs or larger numbers of calves moving through. And earlier this week, the weighted average 500 to 600 pound steer calves were running $320. So moved back above, or clearly back above, a year ago levels, and that sharp run up in calf prices kind of messed with some of the numbers I had, and I'll explain a little bit of what's going on and why from that standpoint. But for the most part, the lower price of corn, increase in live cattle futures prices have combined to give a pop to calf prices here. A couple other things, big picture, goes back or deals with interest rates, and coming at this from a couple of angles. First of all, really from an opportunity cost standpoint. So what kind of return is out there in general for an investment? And for that, I'm using a benchmark, the 10-year treasuries, constant maturity, quoted on an investment basis. Yeah, this is a fancy way of saying if you would do something like park your money in risk-free, relatively risk-free treasury instruments. I have a tough time saying absolutely risk-free anymore when it comes to treasuries, because yeah, they've proven to be not quite as risk-free as they used to be. But the 10-year treasury, that rate had been down below 1% on that investment. So you could lend money to the federal government expecting to be repaid. And the returns for that in 2020, for example, was down below 1%. Then as the Fed raised short-term interest rates, that pushed the yield, or helped push the yield on long-term rates up as well. That was getting close to 5%. And now it's back down a little bit below 4%. Bottom line, if you're looking at doing something like investing in a cow-calf operation, or investing in a feeding backgrounding enterprise, or using the backgrounding enterprise, what kind of return would you want to have on that investment? If 4% is the risk-free rate, you'd want some return greater than 4% for doing something like backgrounding calves. The other interest rate related item on this is the fact that as the Fed increased those short-term interest rates, that really drove up the cost of operating loans, or the operating loan interest rate. Here we've got this showing the low back in early 2022, was down below, say, about 4.5% for the 9th district. That includes South Dakota. And that's just a survey average of agricultural banks lending to the farm sector, specifically for operating loans. And the other rate I've got in there is just the land loan, just for comparison's sake. So as the Fed increased short-run interest rates, that pushed up the cost of funds for commercial banks, and they passed that cost on in terms of a higher operating loan rate for farmers and ranchers. So the operating loan rate here for the first 2 quarters of 2024, all the further the data series, or all the more current the data series is, they had been around 9%, very close to 9% as an average across the entire district. So your rate might be lower, your rate might be higher, but that's the average. And you can see it's a sharp increase from where it was. So bottom line for this is that the long run cost, or the cost here, if you've got an operating line of credit and you're using those funds to background the calves, that could factor in. And it turns out to be a fair chunk of change when you're dealing with 9% interest. So on to backgrounding. What's happening with backgrounding? Well, the backgrounding fundamentals, or the numbers around backgrounding, have changed quite a bit relative to the last couple of years. So if we take a calf and feed it during the winter months, you're probably feeding it some combination of corn and hay, or some sort of combination of things that are tied to the value of corn and hay. Corn silage based on corn, haylage tied to hay, dry distillers roughly tied to the value of the price of corn, or corn as a proxy. So as the price of corn has fallen from, say, a very high level 2 years ago to a projected ballpark right now, $3.60 a bushel, give or take, for a typical South Dakota price, that has a positive effect on the feeding margin. That drives down the cost to feed a calf. The other major cost factor would be the price of hay, and I'd have you focus on 2021, 22, and 23. Those hay prices in South Dakota, that's the NASS all hay price. So price received by farmers that have been averaging around $130 a ton for that average quality other hay. So think non-high quality alfalfa, so maybe a little bit average or lower protein level, but very typical hay produced in the state. So that price at 130 a ton would be very burdensome or a very high cost in a backgrounding sort of ration. And since that price is expected to be lower, or all the cash prices recently have been substantially lower than that 130 level, I penciled in a $95 a ton price right now. I found lower prices for that, depending on where in the state you're talking about. But looking at neighboring states as well, Iowa, Minnesota, Nebraska, that $95 seems to be a fairly reasonable price to pencil in. So let's run some numbers. If we look at the background and cost components, if I have a calf, the calf is worth $300 per hundredweight, and I've got a 5-weight calf, a 550 weight calf, that gives me a $1,650 calf. Corn at $366 a bushel, and hay at $95 a ton. I have a very simple ration that kind of assumes 3 pounds a gain a day ballpark. So I'm using a ration that uses 15.5 bushels of corn and 1.1 tons of hay to get a 550-pound steer up to an 800-pound steer, say around mid-March of 2025. So doing those calculations on a per head basis, the calf is worth $1,650 a head or per animal right now. The corn would be an input cost at around $57 a head, and the hay would cost or be valued at about $104 per head. That gives you a total cost for that calf and its feed of $1,811 and change. So here's where I'm tying back in that interest rate concept. If you're looking at owning, or if you do own the calf and the corn and the hay, and those could be sold at today's prices, you would think you would get $1,811 for that. If you would put that $1,811 into something like 10-year treasuries risk-free, you would expect a return of 4% interest accumulated over 5 months. So 1,800 times 4%, scale that by 5/12 months would give you a 4% return expectation of $30 a head. If you have financing or you're using an operating line for the entire amount, so you're not paying back your operating loan and using those borrowed funds or paying interest on the entire borrowed amount, or entire $1,800 borrowed for 5 months at 9% interest, would be close to $68 a head in interest charges alone. So you haven't made a profit yet, you haven't had a return, and $68 would be just the financing cost. So $30 a head, say $65, $70 a head, ballpark numbers just to tuck away for a little bit. What is happening with feeder cattle, this is just for long run comparison. I grabbed looks like a 15-year chart here from our Bloomberg terminal, and very recently, I believe this would be yesterday's CME feeder cattle price. So this is the weighted average cash price for 700 to 900 pound steers sold across sales, reported by AMS for the entire upper Great Plains area, well, the entire Great Plains, so it stretches down, including Texas. So anywhere that feeder cattle are predominantly sold are averaged together into the feeder cattle index. As of the last couple of days, that price has been averaging $250 per hundredweight, and that's down a little bit from earlier in 2024. But just for comparison, I wanted to show way back to 2014 and 15, the last time we had prices at this level. So just for where our price is at there's the cash price for 8 weight steers nationally. And then a couple things to kind of set the stage for the rest of this. So what's happened to the margins relative to backgrounding calves, feeding them for a while, or even finishing calves? So I've got two margins here that I brought in from the LMIC. So this first one is just the absolute buy-sell margin difference for the price, the raw price of a 7 to 8 weight steer in the Southern Plains with a March delivery, and the 5 to 6 weight November price. And you can see that average had crept up in 2024. So that would have been last year's price. And just to see that had been a little bit lower than the year before, and you can see it had been right in line with the longer run average. So that's one way to think about the margin. How many dollars are there between a calf and a feeder? And similar to that, we can look at the dollar difference, or the typical difference between here we've got fed steers for May, less or relative to the price of calves. So if calves were super high price, they'd be above that line, and calves super low price, they'd be below that line. So a year ago, it was down a little bit below the 5-year average. So those are the kind of margins we're looking at. But then I go one step further and I just look at the gross spread. So this is the difference between, on a per head basis, selling an 800-pound steer, South Dakota price, less a 550-pound steer, South Dakota price. So that margin has looked like this in recent years. So the dollar spread between the feeder and a calf weight and a feeder weight has fluctuated. Way back in 2003, it was around $50, and then it was around $200 for a stretch in 2012. 2015, it got very low, and then recently it's been $200. A couple of years ago, $300. Last year was around $240, and then earlier this October, it was back above $300. But at the time, I was using $300 calf and a futures price of around $245. Also shown on here is the feed cost. So this is the ration from before: 15.5 bushels of corn and 1.1 tons of hay. Not adjusting these, or some adjustment back here in the earlier years to reflect the fact that feeder cattle index used to reflect 775 pound animals for a while. So lighter weights for early part of this. But bottom line, that gross spread is the dollar spread per head between a calf weight and a feeder weight, and the ration is shown on there, and those track pretty well over time. What's happened recently, though? Well, since the last couple of weeks, the calf price has jumped from $300 to $320 a hundredweight. That means that gross margin has shrunk substantially. Feeder cattle futures price has fallen a little bit, and that has further squeezed that margin down. Feed costs have come down ever so slightly as the price of corn has fallen, and instead of running what had been earlier this month, $150 of margin between cost of the calf and feed and the eventual feeder weight on the board, has fallen to $7.75. So for perspective, with those new costs, the interest opportunity cost, running a 5-weight at $320 with feed, you're looking at about $1,920 there, and at 4% interest, you'd expect to, you're taking on this risk of feeding, you would want probably $32, a slight increase to cover your opportunity cost alone. And if that margin is $7, you're not going to see that as a profitable venture. So on the plus side, that means that calf is running at a very high value right now, or can be exchanged for a very high value. So that's the good news. Bad news is This is a very competitive market, and it's being what had been a fairly high profit level has been bid away and is now, on paper at least, below the financing cost and below the opportunity cost from treasury or risk-free returns. Just to highlight a couple things. So what am I using for a target price? For that, if you think about a calf today, run through the sale barn, fed corn and hay, if that would grow to a 7 to an 800-pound steer by March, let's look at the March futures prices. So from Bloomberg, I grabbed a really cool chart from, if you're in a nerdy kind of situation. This is all the March feeder cattle futures contracts bolted together. So currently that March futures price is sitting at $242.45 per hundredweight. So that's the bold light blue line right here at the top of the screen. And you can see that early in 2020, earlier this year, that futures price was at an all-time high for March futures contracts. It has since fallen below last year. The green line is last year's March futures price, but we're approaching getting back to almost the level that the March futures were at last year at this time. A little confusing until you get used to looking at these kind of wacky charts, but and again down here on the bottom to make sense of this chart, it starts in April of the year and ends of March the following year. So it's the life of all the March futures contracts bolted together, overlaid on the same chart to let you see what happens. Okay, you take the average of the last 15 years of feeder cattle futures, smash them all together, average per day, you get that bold pinkish purple line through the middle there, and you'll see it's a pretty flat line. If you average all the changes or all the price levels from the last 15 years and go from this time of year to when the March contract expires in the following year, it's the most boring market or boring line you can imagine staring at. Oh, sorry. Yeah, nothing happens on average because that price is fairly unbiased. The futures price is never correct, but it's wrong to the downside as much as it's down to the upside, or wrong to the upside. So last year, the futures price went from, say, about 260 and fell, got down around 210 around early December before it increased, finishing at around 250. So you can see that March futures fluctuate quite a bit year to year. Okay. From the time you'd put cattle into a backgrounding pen, feed those calves for a while, what happens to the futures price between November when you start this exercise and March of the following year when you stop this exercise? Well, the futures price can fluctuate. It can go up quite a bit and go down quite a bit. When it goes up quite a bit, you haven't done anything, you're better off. You're selling the calf at an even higher price than you started with. But if the price moves the other direction, you lose a lot of money if you don't do anything, because you're going to receive a lot less for the feeder than you would have gotten for the calf 5 months earlier. So here's the last many years, 20 years of how that looks from November to the following March. I'll just point out last year, if you backgrounded calves and didn't do anything as far as managing the risk of that, the futures price and the ultimate cash price increased $20 a hundredweight. So $20 a hundredweight times 800 weights, so an 8-weight, you gained $160 just by the market. So nothing magical you did with your calves or anything else, but the market moved that much. That would be good. But years like 2020 and 2015, the market moved the opposite direction, wiped out $160 per head of value for the calf by the time it reached the 8-weight stage the following year. So that says there's a lot of risk both to the upside and the downside in that feeder market. What might you do? Two ways of dealing with that. One way would be to buy put options underneath, or put a price floor underneath the value of the feeder. And the other thing would be to use something like livestock risk protection to manage against the downside price risk, which can be substantial. And since that price of that coverage is heavily subsidized, it might be a cost-effective approach to take a look at. The volatility in the feeder cattle market. So this is this morning's snapshot of all the exchange traded March feeder cattle contracts. I've got the March contract highlighted. Implied volatility in March right now is at 15%. That's at the low end of the typical range or average we see for feeder cattle. So it doesn't cost prohibitive to lay off the risk in that market at this time. If you want some more information on this, I hope to have I expect to have a column in the LMIC covering some of the national aspects of this topic on Monday. If you don't receive that, there's a link that you can find through the extension webpage under agribusiness, or let me know and we'll get you added to that list. And here's my contact information. If you've got some questions or want some follow-up, email or give me a call, and we can discuss some of the details further. I know it's a lot, sorry. And here's our required stuff, and I'm going to stop sharing. So that's what I had. That's what I'm looking at. You saw I think it indicates you've got a very competitive market right now. It might make sense to look at backgrounding. At the same time, you've got you have a very competitive market, which is, I would suggest, bidding up the price, or really bidding up the price of calves. Good news for calf sellers, bad news for feedlots.
Okay. Well, thanks, Matt. That was a lot of yes, a lot of stuff in those slides as you presented them for us. So, any questions that anyone wants to throw out now? Otherwise, we'll roll to our next presenter and we can do questions afterwards. Since you guys wouldn't tell me what the weather's doing this morning, I'm gonna guess that they're not gonna be bringing a lot of questions forward right now. So, Sarah, why don't we move towards your presentation, and we'll go from there. And then we'll, like always, turn off the recording at the end and you guys can ask your questions at that point.
Okay, so today I'm going to be talking about Farm Bill outlook for going into the end of 2024 and beginning of 2025. So I gave this talk about the Farm Bill last year at the October Ag Economic Dialogue. So it's really fun to be able to give this talk again, and it's fascinating how much stuff has changed and how much hasn't changed. So I'm going to go over a timeline of the 2018 Farm Bill and kind of looking forward to what could happen at the end of 2024, beginning of 2025. I'm going to talk about some of the proposed changes that were part of the report released by the House Ag Committee. I'm going to talk about how these changes would affect agriculture, particularly in South Dakota. And I'm going to give some outlook for 2025 of what we can expect. So last year, October 2023, I gave a talk about the same topic, which was the Farm Bill. At that time, the Farm Bill had expired, so we were kind of waiting to see what happened, if a stopgap measure would be passed. At this time in October, Senator Grassley from Iowa had said we could get it done by the end of the year, and it turned out he was right. So they ended up passing that stopgap measure in November before the end of the year. And then the 2018 Farm Bill was extended until September 30th, 2024. But now we're back in the same situation where the Farm Bill has expired, but the situation has changed slightly as we're in an election year, quickly approaching. So there's two main expiration dates to be aware of, which are the end of the fiscal year, which ended September 30th, and then the end of the crop year, which will end on December 31st. And as we'll talk about, if we reach the end of the crop year without some sort of extension or a new farm bill passed, there will be some programs and funding affected or already being affected now with the expiration of the farm bill. So this is the timeline I put together so we can look at what's happened over the last 5 years. So the current farm bill, which is the 2018 farm bill, was enacted in December of 2018. Fast forward to September 30th, 2023, this farm bill expired. So typically there's a new farm bill every 5 years. Either the old farm bill can be extended in that last year or a new farm bill could be passed. So in the case of the 2024 farm bill, the 2018 farm bill ended up being extended on November 16th, 2023. And then fast forward to 2024. So in September, there was a threat of a government shutdown. You probably saw that or heard about it in the news. So the Senate passed a stopgap measure to prevent the government from shutting down. At that same time, 139 House Republicans put out a letter urging the passage of a new farm bill before the end of the year. So there's been a lot of push from a lot of different people to try to get a farm bill in before the end of the crop year, which is December 31st. And then, as I mentioned, September 30th, the Farm Bill extension, which was passed last year, it expired. So we're currently in an environment with no farm bill. This has affected some programs so far, but others it won't affect until the end of the crop year, which you can see on the timeline is the end of the year. And then if no extension or new farm bills passed by that time, then in January 1st, 2025, some of these price support programs, particularly the dairy programs, will revert back to permanent law, which was written in the 1940s. And as you can imagine, the policy was a lot different back then. So it's definitely not something that's desirable for producers or consumers. So as we're thinking about the potential options for a new farm bill moving forward, we can look back at the past and think about what's happened and then use that to think about what could happen at the end of this year and beginning of next. So there's been a lot of variation in how long it takes to pass a farm bill from the time it's enacted, from the time it's introduced until the time it's actually enacted. For example, the 1973 Farm Bill only took 3 months from introduction to enaction, compared to the 2014 Farm Bill, which took 21 months from introduction to enactment. So in 1976, the fiscal year changed. The way the fiscal year ended in the United States changed. So that's why I'm using it here as a comparison. So of the 9 farm bills we've had since that new fiscal year system started, only 2 of them have been enacted before the September 30th expiration date. And of those 9, 4 of those were enacted within 3 months after the final fiscal year for which the programs were authorized ended. So we're thinking October, November, December. 10 of the 13 farm bills enacted since 1965 were enacted before December 31st of the expiration year. So you can see it is pretty common to get the farm bill passed before the end of the year historically. And when we're thinking about extensions, it used to not be something that happened in the past, but it's becoming more common to extend the previous farm bill before releasing a new farm bill. So we saw extensions in 2002, 2008, and then the 2018 farm bill, which is the one we're talking about now. So this is the baseline spending for the farm bill. This is released by the Congressional Budget Office. So every few months, the Congressional Budget Office releases their projected spending of the government over the next 10 years. This is supposed to be kind of the boundaries that when legislators are proposing changes that they need to stay within these spending boundaries or budgets. So you can see on the left is what I presented in October of 2023 last year. And on the right is the most recent Congressional Budget Office projection, which was released in June. So this is what we're looking at for 2024. So this is supposed to be an unbiased, neutral, not politically influenced projection of what the budget will be based on current economic conditions and policies of the government, So you can see if we're looking at the change from left to right, you can see that it's hard to see because it's hard when you put millions of dollars on a chart. It can be hard to see changes, but the green bar, which is the Title I commodities, the projections for the budget have increased since last year. And Supplemental Nutrition Assistance Program called SNAP, formerly known as food stamps, this is the blue bar, it's decreased. The projections for the budgets have decreased since this time last year. So on the chart, I focused on the 4 biggest titles within the Farm Bill, which are Title I commodities, Title II conservation, the crop insurance title, and then the nutrition title. So there's some other small titles, which I'll talk about in a little bit, that make up less than 1% of the total spending of the Farm Bill, but do impact us and do impact farmers as well. But these are the main titles within the Farm Bill. So again, we've seen the budget projections get smaller, and we've seen the commodity title projections expand since last year. So what's happened since last year? We've seen changes in the agricultural economy. So we've seen a downturn in the economy. Net farm income is projected to be down in 2024. So we've seen a sharp decline in that. And what's driving that? So that's being driven by commodity prices and input prices. So we've really seen a decline in commodity prices, especially since giving this presentation last year, looking one year forward, it's been a pretty sharp decline in corn and soybean prices in the US. So that's affected the financial position of a lot of farms. And as Matt talked about in his presentation, we've seen a change in interest rates, which is one component of input costs that has really affected the budget of a lot of farms. So we've seen an increase in interest rates over this time. The Fed did decrease their interest rate a little bit, so some of that's starting to soften, but still interest rates are at levels that we haven't seen across the last few years. Also, there's other components to inputs like fertilizers, diesel fuel, these types of things. So some of these products are at higher levels they're better than we've seen previously. For example, these are nitrogen, DAP, and potash, the 3 main input nutrients in corn production. So we saw some of those kind of peaking in 2022, and they've come down since then, but they're still higher than the levels we've seen in beginning of 2020, end of 2019. So these lower commodity prices and higher input prices are putting a squeeze on the farm financial positions. And that new farm financial environment that we're in is affecting some of the discussions about the Farm Bill and the way that we're thinking about these things. So the House Ag Committee released their markup of the Farm Bill back in May. During this markup, they considered over 50 different amendments. So unfortunately, we don't have time to talk about all of those today, but I'm going to talk about a few which I think are most relevant or interesting for you all. One of the main ones they've proposed is changing the Title I commodity programs. These are programs called ARC and PLC, price loss coverage, agricultural risk coverage. So these are direct payment programs from the government to farmers designed to cover losses. So 2 of the things they're proposing are increasing the prices, reference prices for the commodities in these programs. And also they want to allow changes to the base acres. So when a farmer enrolls in these programs, they have to report their base acres. The base acres are used to calculate average production history, which goes into the calculation for ARC or PLC payments. So allowing changes to the base acres would potentially cause the payments for these programs to change. So they're proposing increasing the reference prices. This would increase payout for commodities, particularly for peanuts, rice, wheat, and cotton, most of which only wheat is the one that would affect South Dakota, but most of these others are southern crops. Another change they're proposing, which I found really interesting, is to suspend Section 5 of the Commodity Credit Corporation Charter Act. So this CCC can be used by the Secretary of Agriculture to fund different specific ag problems outside of the Farm Bill. So over the last few years, we've seen quite a bit of unprecedented spending on agriculture outside of the Farm Bill. One of those was the Climate Smart Commodities Program. You may have heard a little bit about this, but it was a grant program to invest in research and education related to climate smart commodities. There was a $3.1 billion investment, and that was money that came from the CCC and was used by the Secretary of Agriculture to fund that program. So for the future, they're proposing for that to not be allowed anymore, which could affect this kind of spending we're seeing outside of the Farm Bill on agricultural programs and problems. Another thing to think about with this version of the Farm Bill being proposed by the U.S. House is that it's currently $33 billion short of being fully funded, even with taking money from the nutrition title. So to fund all these increases caused by changing base acres and changing reference prices, because the Farm Bill is a set amount of funding, as I showed you from the Congressional Budget Office, if you increase one title of the Farm Bill, you have to take it from another title of the Farm Bill. So to increase the Title I commodity program, they propose taking some money from the nutrition title or SNAP. So even with doing that, they're still short for covering the funding of their proposed changes to the Title I commodity programs. And this is a problem because the Senate hasn't released their markup of the Farm Bill yet. And some of those in the Senate were adamant that they were not budging on changes to the nutrition programs, that they were not willing to compromise on that, and that they would not allow any changes to nutrition spending. So even with taking money from nutrition spending, the House's markup of the Farm Bill is still $33 billion short. So a way to cover that difference needs to be figured out. I also want to bring up that there's been some talk of a direct assistance package for farmers due to this downturn in the ag economy that I've talked about. There's also some talk of disaster aid. So with the hurricanes, there's been some detrimental effects to agricultural production in the South. So there's been a lot of discussion in the ag media from legislators about providing funding for disaster aid and for this downturn in the agricultural economy, or both. Some people have mentioned that as part of a Farm Bill extension. Others has mentioned it as some sort of direct payment outside of the Farm Bill. So that's another topic to consider that will affect farmers. So I want to talk a little bit about how these proposed changes to the Title I commodity programs would affect farmers, particularly our South Dakota farmers. So on the left, these are the change in yearly spending for the mandatory update in base acres from current base acres. So if the proposed change in the base acres goes through, if the farmers are required to adjust their base acres, which are used to calculate the ARC and PLC programs, this is how it would affect the Farm Bill spending at the county level. So the darker the blue color is a positive effect on spending in that region. A red color is a negative effect on spending in that region. So we can see in South Dakota, in a lot of counties, it would have a positive effect. This dark blue color, which is more than $300,000 increase in spending in that county. We can see in other regions it would have a negative effect. So for example, Montana has quite a few counties where that would decrease spending from these programs. And then we see it also affects some counties in Illinois and in the Delta region in the South. But in South Dakota, most of this would be a positive effect on Farm Bill spending in these counties. And then we can break out these changes by commodity. So the table 3 on the right looks at the impact of increasing the statutory reference price on ARC. So we know this would change both PLC and ARC, but this is the most commonly enrolled in program in South Dakota. So I wanted to focus on this one. So on the program crop column, they break this out by corn, soybeans, wheat, seed, cotton, peanuts, and rice. And then they look at how much increasing the statutory reference price by 10% would increase the spending. So this is the blue column here. This is the 10% increase in statutory reference price. And that's how much $1 million it would increase it's the total ARC PLC spending for each commodity if that 10% increase in statutory reference price comes to fruition. And then they break it out by ARC and PLC, how it affects both of them. But the column I want to highlight the most is the total increase. It's this green column here. So this is the change that this proposed change in statutory reference price would have on each of the commodities spending. So we can see the three main commodities grown in South Dakota, which are corn, soybeans, and wheat. Corn would have a 36% change. Soybeans would have a 49% change, and wheat would have a 50% change. So these would be positive changes in spending in these commodities. But we can see that most of the change goes to the southern crops, which are seed, cotton, peanuts, and rice. These changes, multiple of them are over 100% increase in spending on these commodities. So while this change would have a positive effect on the commodities we grow here in South Dakota, a lot of this change is focused on the positively affecting the southern crops like cotton, peanuts, and rice. So what's the expectations going to the end of 2024, beginning of 2025? What happens if we don't have a farm bill or farm bill extension passed by the end of the crop year? So like I mentioned, the programs revert back to how the law was written in the 1940s, which is called permanent law. This would mainly affect the dairy program starting on January 1st. So it would not affect the crop programs until the end of the 2024 crop year, which would end December 2025. But it would affect the dairy program starting December 1st, 2024. So the 2024 crop year starts now in the fall of 2024 and runs through December 2025. There's some other titles that rely on mandatory funding. These are the smaller titles I was talking about earlier: trade, research, energy, horticulture, and miscellaneous. And while these programs make up only about 1% of the mandatory spending of the Farm Bill, they do affect us at universities and do affect farmers as well. So some of the research and education and extension grants and funding have not come through because of this delay in the Farm Bill. And if those grants are used to fund research and education that benefits farmers, then this also affects farmers as well. Conservation Reserve Program and some of these other small programs, these expired September 30th. And then a lot of the other big programs have provisions that allow them to keep being funded even with the Farm Bill being expired. The Inflation Reduction Act included funding for some of the big commodity programs like EQIP, CSP, ASEP, and RCPP. So these remain funded through 2031. We don't have to worry about those. And SNAP is reauthorized until December 20th through a different appropriations bill. But some of these small things that are affected by not having a farm bill will affect South Dakota farmers and those who work at universities as well. So the House released their version of the Farm Bill, their markup in May, but we have not seen anything released from the Senate, so that would be something to watch. Congress may consider another extension. There will only be one chance to pass some sort of extension or even a new Farm Bill, a 2024 Farm Bill, but the chances of that would be really slim to see some sort of agreement reached by then. So after the election, there's one lame duck legislative session where something could potentially be passed, but it's likely that there's going to be other legislation that takes priority over passing a Farm Bill. And I just don't think that's going to be a priority at that time. For example, the fiscal year 2025 appropriations funding, it's likely that will try to be pushed through at that lame duck session. So there's a small chance that we could see some sort of Farm Bill extension or something related to the Farm Bill voted on in that session, but not likely. So as I talked about, the version of the Farm Bill proposed by the House Ag Committee back in May has over 50 different amendments introduced and proposed changes. Some of those changes that are most relevant to farmers are the effects to the Title I commodity programs in the Farm Bill. The proposed changes are changing the base acres and changing the reference price, which will potentially increase direct payments to farmers for the change in reference price. And then for the change in base acres, it will increase spending in some regions of the US and decrease spending in other regions. So those are the two main changes. Again, as I mentioned, that proposed change is still $33 billion short. So the budget has to be balanced before that could come to fruition. And then there's been some discussion of providing some direct aid to farmers and to those who are in agriculture and involved in the disasters from the hurricanes. So this could be outside the Farm Bill most likely, but there's also been some talk if a Farm Bill extension is passed that this could be inside a Farm Bill extension. If some sort of extension or Farm Bill is not passed by the end of the year, this could cause problems for some of the funding areas, particularly for dairy funding. And for these smaller titles that are not part of the four main Farm Bill titles, but contain crucial spending, especially for universities and grants and extension. So we have our statements. And then here's my contact information. I'm happy to take any questions, or if you want to email me or give me a call, I'm happy to follow up. I've been following this topic for a while, and I'm planning to continue following it as we head into the end of 2024 and 2025, and we'll see what happens.
Thank you, Sarah. Questions for Sarah or Matt, anyone?